Stock Market for Beginners Step-by-Step Guide Part 1. Welcome to Cash Street, where cash is always king. I want to show beginners how to invest in the stock market step-by-step in this video. Keep in mind that the objective of investing is eventually to live off our investment portfolio, but we must start somewhere. We can't simply click our fingers and be tasting mixed drinks on the ocean side living off of profits. Let's begin with the fundamentals and go through the steps necessary to begin investing. Also, everything here is free. There are no extra courses or anything at the end that require payment. If you want to skip to a specific section, you can find the timestamps in the description that follows. Therefore, I personally invest in stocks for one reason: passive income, not active income. In essence, there are two ways to earn money. One is to work all day, whether in an office, on a construction site, in a customer service, or elsewhere, and the other is called active income or work income. The second kind of income is passive income, which occurs when you own an asset that generates income for you, like a stock. You get paid without having to put in any extra effort once you own it. Therefore, it is entirely passive, which, in my opinion, is a primary reason to invest in stocks. You won't have to work for every dollar you earn. Therefore, a stock is a security that denotes ownership of a portion of a company. So, if you own Coca-Cola stock, for instance, you actually become a very small shareholder in the company. Therefore, if we examine Robert Kiyosaki's cash flow quadrants, you can join the fourth square, where you own a portion of a business without having to work for it. Therefore, you must join a brokerage firm to purchase stock. A platform that lets you buy and sell stocks is a brokerage company. Fortunately, this is not 1995. You don't need a risky Wall Street broker to make trades. If you're just starting out in investing and looking for a cheap broker, Robinhood and Webull are popular choices. With them, you can buy and sell stocks for free. On the other hand, if you have more money and are looking for a platform that has been around for a long time, try Charles Schwab, Fidelity, or TD Ameritrade. If you live in the United States, you can sign up for them by searching for them on Google, visiting their website, filling out a few forms, and then beginning with finding a partner. Now comes the crucial part. This is where a lot of people can make mistakes. They get greedy, don't do the work right away, and instead of making money through foolish, ignorant investing, they lose money. Therefore, before you can choose stocks, you need to decide on an investment strategy. So I'm going to talk about 4 different ways to invest and their advantages and disadvantages. Choose the design that you will think will work best for your particular circumstance and investment strategy. Therefore, dividend investing is a great strategy for passive and dependable income in all 4 styles. 2. Warren Buffett's strategy of value investing, which made him one of the wealthiest people in the world. The third strategy, growth investing, is the one Cathie Wood has been using to make a lot of money recently. The final kind of investing that we'll discuss is passive index fund investing, which is a relaxed approach that works well over the long run. So let's start with dividend investing. With this strategy, you can almost always count on receiving dividend payments on a quarterly or monthly basis. A type of investing known as dividend investing involves purchasing stocks that distribute a dividend from their earnings. They usually get paid once every 3 months, once every quarter, or once every month or half yearly. So in the event that you select some great profit stocks that are one method for guaranteeing automated revenue moving into your ledgers over time, yet you got to play things brilliantly, you can't simply put your hand on a piece of paper and choose the ones that deliver the most elevated profit. That is excessively hazardous. We must comprehend the figures behind the stock. So here are some things to look for in a dividend stock. I want you to pay attention to 4 main things. I need to show you these 4 measures. So we will utilize Coca-Cola stock for the model. The site that I prefer to use to get the stock's measurements is Yippee Finance. Therefore, all we have to do is click on this link, and this page will provide us with a summary of Coca-Cola stock. Now, what we want to do is click on statistics and scroll down until we see dividends and splits. This will give us some important information about Coca-Cola stock's dividend side. So one of the primary insights we ought to take is the actual profit. As a result, we can see that Coca-Cola pays a dividend of $68 per share, giving it a dividend yield of 2.86%. Therefore, if we purchase $100 worth of Coca-Cola stock, we will receive a dividend of 2.86 per year. Given that the market's average dividend is 1.3%, 2.86% is not bad. So it's in every case great to contrast things with the normal or to their rivals, and that is the manner by which you discover how great the stock's numbers are. The payout ratio is the next thing we want to examine. The payout ratio indicates how much of a company's earnings are distributed as dividends and how much is reinvested in the business. Okay, so if a stock earned 10 cents per share and had a payout ratio of 40%, it would give out 4 cents as a dividend and put 6 cents back into the business. The payout ratio for Coca-Cola is 82, which indicates that the majority of the company's earnings are distributed as dividends to shareholders. Now they reinvest the remaining 18% in the business. To be honest, this is a very high payout ratio because Coca-Cola is such a mature company that is more of a cash cow than a growth company. However, in general, I would prefer the payout ratio to be significantly lower than 80%. When a company does not distribute all of its profits as dividends, it is always a positive sign. When we talk about growth, the third thing we need to look at is the company's past earnings. Now that we have clicked on the summary section of Yahoo Finance, we can see their previous earnings in detail by scrolling down a bit. Therefore, earnings and revenue are represented by the blue and green lines respectively, and Coca-Cola's earnings were consistently rising. That is up until 2020 when they obviously suffered from the pandemic and saw a decline in earnings. However, in general, you would expect earnings to be trending upward, so I suppose we will give them a pass because of the pandemic. The dividend history of the company is another important factor to consider prior to purchasing dividend stocks. Do they have a track record of consistently paying dividends, or are they more erratic? So when looking at dividend history, I like to use the website Macro Trends, which is easy to find on Google. With Coca-Cola stock, we can see that they have a very long history of paying dividends. As a matter of fact, it appears to be that they've never dropped their profit payouts throughout the history of their stock starting around 1974 according to this chart. Therefore, if we purchase the stock in the future, it is highly unlikely that we will reduce their dividend payments even during economic downturns and recessions. As a result, Coca-Cola has long been a popular dividend stock for many reasons. That's a delicious and dependable dividend. So other profit stocks that are very well known that you might need to investigate to fire developing a portfolio is 3M ticker image Profit Yield 3.3%, so that is a buyer merchandise organization with a seriously decent profit to it. Johnson & Johnson's second symbol, J&J, has a dividend yield of 2.5% in the healthcare industry. Or you could look at something like it, which has a ticker symbol that is a little bit riskier but has a dividend yield of 8.5%. So that is excellent in the market. So folks, get and gradually get in stocks that are dependable with a decent plan of action behind them and begin developing a portfolio that ideally one day you can resign off. It won't be anytime soon, so don't get too excited about it. However, if you start building and allow for compound interest, a portfolio can grow into something quite impressive if you give it time. Therefore, the benefits of dividend investing include receiving income from the stock's capital gains and passive dividend income, which is fairly dependable, particularly if you invest in solid business models. Because of these two sources of income, the main drawback of dividend investing is that older businesses may not have as much room for rapid growth as we find in other types of investing. Therefore, it is a much safer and more dependable method of investing. But we won't typically see those big YOLO returns, as the youth refer to them. Okay, let's move on to the type of investing that made Warren Buffett a billionaire, value investing. I'm not saying that value investing will make you a billionaire. We're not all Warren Buffett, but it can yield very healthy returns if done correctly. Therefore, buying stocks at a price that is lower than their value is the core of value investing. Similar to bargain hunting, you go to the stock market rather than a garage sale or a retail establishment. Therefore, the question that arises now is, wait, how do we know if a stock is cheap? Do we just look at the price? If the price goes down by 20%, then it is cheap and a bargain. Sadly, it is not that simple because the price drops frequently. Additionally, the business loses value. Therefore, determining the business's intrinsic value is essential to value investing. Once you have this information, you can simply compare it to the price to determine how much of a bargain you are getting or how badly you are being ripped off. I also made a video about this that explains how to figure out a stock's value in 3 steps. Consequently, I'm going to leave that in the description section below. Once you understand what you're doing, it's actually not that hard to do. All you have to do is look at various stocks and compare their prices to their value. That's what Warren Buffett did when he was younger, but back when he didn't have access to the internet, he used Moody's manual instead. He claimed that he went through the entire book twice just by reading over various businesses and looking for bargains by looking for high value and low prices. This is similar to what Buffett did, but because there are a lot of stocks on the stock market, looking for those with low PE ratios is one way to find value stocks. A price-to-earnings ratio, also abbreviated as PE ratio, basically compares the price to earnings. If the number is low, it indicates that the stock's price is low in relation to its earnings, while a high number indicates that the stock's price is high in relation to its earnings. You can easily locate the PE ratio for stocks by returning to our friend Yahoo Finance. When we get to the summary section, it says 29 for Coca-Cola. Therefore, the price is 29 times higher than annual earnings, and it will take approximately 29 years to recoup our investment if earnings remain constant. Now, if you want to know if 29 is high or low, one way to find out is to compare it to the average PE ratio of the market. The market's PE proportion is lounging around 29.3 at this moment, so Coca-Cola is around the normal cost of the market cost to income. It is not really less expensive or more expensive. Therefore, Coca-Cola is unquestionably more of a dividend play than a value play. Alibaba, a Chinese e-commerce company, is one example of a stock that is quite popular with value investors. Although the stock is a bit of a controversial investment, well-known value investors like Charlie Munger and Ray Dalio have bought it after its recent dip. Another value stock is Berkshire Hathaway, which is owned by Warren Buffett, the company's chief investor, who also owns a number of stocks under the Berkshire umbrella. Then, at that point, we have GameStop. This was a colossal worth play, particularly a year prior before the entire Reddit mutual funds adventure. And bank stocks are somewhere else to begin for esteemed financial backers this year, particularly with their low PE proportions. Buffett has gotten involved with them over the recent years. While I'm not recommending that you buy these stocks, they are a good place to start if you're looking for a value investment. So, this is just part 1 of step-by-step guide for beginners. Search for part 2, which will be posted on my channel. Thank you from Cash Street, where cash is always king.